Welcome back to the deep dive. It's the first full week of 2026. And, the commercial real estate headlines are really giving us a remarkably detailed map of the year ahead.
They really are.
We are certainly seeing confirmation that the industry has moved past peak uncertainty. There are definite signs of stabilization, but the major takeaway is market bifurcation.
That's it. That is the crucial distinction we need to make today.
Performance is just swinging wildly based entirely on asset class and, well, geography.
Absolutely. Our mission today is to do a surgical deep dive focused specifically on this shift. We're going to put a special emphasis on the Texas Triangle, particularly the Dallas-Fort Worth market, and the fiercely resilient neighborhood retail sector.
Right.
We need to understand the data that proves why DFW retail is acting as this undeniable bright spot amidst, wider economic anxiety and some very serious pockets of distress.
And our sources for this deep dive are, well, they're a stacked portfolio of recent reporting. We're covering everything from the reawakening of capital markets to massive corporate power shifts right here in North Texas.
And some pretty shocking fraud allegations in the Sunbelt multifamily space.
Yes. We've extracted the crucial details so you can navigate 2026 with confidence.
So let's start exactly where the good news is strongest. Dallas-Fort Worth. The underlying fundamentals here are just so overwhelmingly powerful. ULI and PwC, in their joint report, they named DFW the #1 U.S. real estate market for overall prospects for 2026. This isn't just, optimism. This is statistical confidence in long-term growth.
That's an incredible endorsement. And when we drill down and look specifically at retail performance, the numbers are absolutely stunning.
They really are.
The latest Weitzman forecast confirms that 2025 marked the third consecutive yearly record for retail occupancy. It hit a near-perfect 95.3%.
For anyone investing or brokering commercial assets, that level of saturation in a major metroplex it's huge.
And this isn't a peak they are expecting to fall off of, right?
Not at all. Weitzman Project's occupancy will hit a new all-time high of 95.4% in 2026. And what makes that data point so powerful is that this growth is projected even with new retail construction jumping to 3.8 million square feet.
Which is the most since 2018.
Exactly. The sources are definitive on this. DFW is experiencing, and I'm quoting here, the tightest retail market DFW has ever seen.
Okay, so let's unpack that growth. We can pinpoint the exact engine driving this record-breaking performance.
Grocery-anchored retail.
Yes, grocery-anchored retail. These are the neighborhood community centers, the essential services that thrive no matter what. They were 96.4% leased.
An all-time high for that specific subsector.
And the composition of the new construction, that really tells the whole story, doesn't it?
It does. Grocery stores accounted for a massive 82% of the 2.4 million square feet of new retail space delivered in 2025.
So this explosion of activity was largely spurred by the aggressive entrance of H-E-B into North Texas.
Right. It resulted in 18 new grocery stores opening in 2025 alone, with another 34 already slated for 2026 and 2027.
The pace of that expansion is just,
Wow.
It's incredible. It's why DFW is officially deemed the most active grocery market in the entire country.
And that level of new competition, it forces strategic defensive moves from the incumbents.
It does. And that's a major anecdote for anyone tracking essential retail strategy. Walmart is responding to this intense grocery competition.
What are they doing?
They're breaking ground on 3 massive new supercenters simultaneously in Frisco, Melissa, and Salina. This is a clear long-term commitment to the region.
And to put that move in context for you, those are the first new supercenters they have opened in DFW since 2013.
So a gap of nearly a decade.
A huge gap. It highlights how serious the battle for essential retail dominance has become. And it shows, profound long-term confidence in the stability and growth of these North Texas suburban markets.
That confidence, it's clearly backed up by institutional capital. We have seen some massive transactions recently that demonstrate a deep underlying appetite for high-quality North Texas retail.
Yeah, let's walk through those key institutional deals from the end of 2025.
Please.
Absolutely. So the big one was the $785 million sale of Plano's Legacy West, that sprawling 35-acre mixed-use development.
Wow.
It stood as North Texas's largest single real estate transaction of 2025. And this wasn't just a big sale. It was a testament to the value placed on these mixed-use environments in affluent suburban corridors.
And that institutional interest wasn't an isolated event, was it?
No, not at all. You also had the $78 million sale of shops at Legacy North, also in Plano, For those who track transaction thresholds, that confirms that high-quality suburban retail is attracting top-tier investors.
Investors willing to pay a premium for that stability.
Exactly. And that corporate stability is solidifying the entire DFW foundation. AT&T is officially shifting its global headquarters from downtown Dallas to Plano.
Right, to 5400 Legacy Drive by 2028. So what does that consolidation of their central Dallas, Plano, and Irving offices into a single suburban campus? What does that mean for the region?
It's a huge symbolic vote of confidence in the suburban DFW market. It signals that companies are optimizing their footprint and that, legacy office cores are potentially losing out to these integrated suburban campuses.
And you also saw Texas Instruments begin production at its new semiconductor facility in Sherman.
That's right. This diversification from tech and telecom to manufacturing, coupled with the relentless population influx, it just confirms that North Texas CRE is showing clear signs of stabilization.
That makes the DFW success story less about a real estate cycle and more about, well, a fundamental economic shift. So if we zoom out to the national level, how do these Texas trends fit into the wider picture?
They align perfectly.
Yeah.
National retail fundamentals are widely described as the strongest in a decade.
A whole decade.
Yep. We're seeing major investment interest because the demand for space is fierce. Data suggests 98% of new retail spaces are being leased within 9 months of listing.
That's incredible.
Plus, we saw 28 retail-focused investment funds launched in 2025, and they collectively raised $4.5 billion.
That confirms the capital is chasing this asset class, but we know the market isn't uniform. Let's analyze the major bifurcation happening within the retail sector itself. Where are investors finding that resilience?
Well, what's fascinating is the continued demand for experiential and essential net lease assets. Take WP Carey, for example. They just acquired 10 large Lifetime Fitness clubs for $322 million.
And for those unfamiliar with the financing structure, can you quickly explain what a sale-leaseback means in this context?
Certainly. So in a sale-leaseback, WP Carey buys the real estate from Lifetime Fitness and then immediately leases it back to them on a very long-term lease.
Okay.
It's a mechanism that provides Lifetime with a massive cash infusion for growth, while WP Carey locks in a long-term, high-credit quality tenant with predictable income.
And this kind of high-end experiential retail, this so-called athletic country club model, is proving incredibly resilient.
It really is. In fact, Lifetime becomes WP Carey's third largest tenant by rent.
So we have the winners locked in: essential neighborhood retail and high-end experiential concepts. Now, what about the old legacy players?
On the legacy shopping center side, we see Brookfield Properties resurrecting the GGP General Growth Properties name for its mall division. This signals a renewed focus on operating those top-tier, high-end shopping centers.
A move to consolidate and survive. But the luxury retail sector specifically is under, well, it feels like an existential threat.
It is, and the headlines are dramatic. Saks Fifth Avenue's parent company, Saks Global Enterprises, is preparing for a Chapter 11 bankruptcy filing.
And that's after missing a $100 million interest payment.
Correct. This is a classic case of debt overriding fundamentals. The previous merger with Neiman Marcus saddled the company with $2.2 billion in debt, and vendor payments have been so delayed that over 100 brands have reportedly stopped shipping products to Saks.
It's hard to overstate the symbolic weight of that collapse. When analysts start suggesting that the highest land value for the iconic Fifth Avenue Saks flagship is likely not as a retail store.
That tells you everything you need to know. The old luxury department store model is truly broken, regardless of how good the real estate is.
And even in the messy business of big box liquidation, complexity remains high.
It does. The planned $997 million cash sale of 119 JCPenney stores, that's 16 million square feet of space, it hit a major snag. That transaction is now in legal limbo over a dispute involving a mere $5 million deposit.
Wow.
It just illustrates the difficulties in liquidating these massive multi-asset legacy portfolios, even when institutional interest is technically there.
So if DFW is a fortress for neighborhood retail, how do we reconcile that incredible success with the broader distress hitting the Texas Triangle? Because the news isn't all rosy for the Sun Belt.
We can't ignore the major debt challenges. We're seeing over $826 million worth of troubled commercial real estate loans headed to January foreclosure auctions across the Texas Triangle. That includes DFW, Houston, Austin, and San Antonio.
And Dallas County accounts for a significant portion of that distressed debt, right? Something like $280 million.
That's right.
And what assets are primarily driving those foreclosures?
It's multifamily. The major foreclosure cases in Dallas include a large 650-unit multifamily complex owed by the embattled syndicator Tides Equities. They're facing a $76.4 million loan challenge.
And this feels symptomatic of the pressure point caused by rate hikes on those variable rate loans.
It is. And this really requires us to look at the collapse of syndication models in the region. It offers critical context for the DFW distress. The dramatic fall of John P. Venetos' Lurin Capital, a Dallas-based 10,000-unit multifamily empire, is a huge cautionary tale here.
A tale about the risks of that rapid acquisition boom.
Exactly. By late 2025, over half of Lurin Capital's holdings were either in foreclosure or handed back to lenders. And what's especially troubling are the allegations of fraud that have surfaced.
What kind of allegations?
Ex-employees claimed Lurin inflated repair costs and invoiced for work not done just to draw loan funds early. It got so bad that city officials in Plano deemed at least one apartment complex decrepit or uninhabitable.
This environment of distress is clearly fueling a dramatic surge in government enforcement. We aren't just seeing foreclosures, we're seeing federal charges.
That's the critical shift. The national backdrop confirms this enforcement trend is serious. The SEC, for example, charged executives of drive planning with a $372 million Ponzi scheme.
And this involved what they called sham real estate bridge loan investments, defrauding over 2,000 investors.
And just for context, a bridge loan is essentially a short-term, high-interest loan. It's often used to acquire or stabilize a property quickly before refinancing with longer-term, cheaper debt. The fact that the SEC is aggressively targeting these schemes shows how much scrutiny is now on the capital staff.
There was another case too, right, with JLL?
Yes. A federal judge recently awarded JLL $21.7 million in restitution in a separate mortgage fraud scheme. In that one, investors falsified a $96 million sale price to get an inflated $74 million loan on an Ohio apartment complex.
So this heavy scrutiny on underwriting, appraisal fraud, and financial representations, it signals a profound shift.
It does. Lenders and government agencies are no longer tolerating the sloppy or fraudulent underwriting practices that characterize some of the earlier cycles.
Okay, shifting now from distress to deployment, let's look at the broader capital environment. Because despite these pockets of distress, there are clear signs the market is beginning to thaw.
That's correct. CRE is indeed moving past peak uncertainty. One indicator is CMBS issuance, which reached its highest level since the post-crisis period of 2007 to 2009.
And CMBS, commercial mortgage-backed securities, those are pools of commercial loans packaged and sold to investors. So increased issuance means more confidence.
It indicates confidence in future credit quality, yes. And we are tracking a substantial amount of sidelined money. Deloitte reports that a staggering $585 billion in CRE dry powder, capital raised but not yet invested, is poised for deployment globally.
So Colliers is projecting that this liquidity, combined with lenders beginning to ease restrictions, will drive transaction volume growth of, 15 to 20% in 2026?
That's the projection. The capital is eager to move.
However, we can't ignore the immense hurdle remaining. The debt cliff.
That's the big one. Over $1 trillion in commercial real estate loan maturities are expected in 2026. A lot of this maturity wall is actually due to extensions that were granted over the past 2 years.
And this mountain of maturing debt will still face high borrowing costs. The Fed might hold or cut slightly, but the 10-year Treasury is expected to stay near or just below 4%.
Which ensures that borrowing costs remain elevated. It means that the gradual thaw in capital markets offers no sudden relief for those needing to refinance troubled assets.
And finally, we have a major political wildcard that could fundamentally shift where all that dry powder gets deployed.
Right. President Trump recently announced that he's taking steps to prohibit large institutional investors from buying single-family homes,
framing it as a policy to protect home ownership and affordability.
And this is a massive factor for capital allocators to consider. This policy immediately caused single-family rental REIT stocks firms like Invitation Homes and American Homes for rent to tumble 3 to 5%.
Just the threat of it.
Just the threat of regulatory blockage is enough to make institutional investors pause their residential acquisition strategies.
And that raises the crucial question for the entire commercial market. If these massive institutions are effectively pushed out of the single-family residential sector, where will that sideline capital flow?
It creates a pressure cooker scenario. Historically, when one asset class becomes politically risky, capital seeks sanctuary in the most stable, cash-flowing commercial sectors.
So let's bring it all back home for you. The key insight is not just that DFW is growing, but that DFW retail is an undeniable fortress. It's a bright spot driven by essential grocery expansion and high-value mixed-use sales like Legacy West.
Right, this is not a generalized recovery story. This is a story of extreme asset class selectivity.
Commercial real estate leaders are laser focused on discipline. They're avoiding the sloppy underwriting that led to these recent syndication collapses.
Absolutely. Top executives across the industry agree that the key decision for firms this year is where not to deploy capital. They're prioritizing cash-flowing assets in fundamentally strong, demographically driven markets like DFW over high-risk or legacy assets.
Which leaves us with the provocative thought for you to consider as you map out your strategy for 2026 and 2027. If political pressure and regulation successfully push institutional capital out of the single-family residential market,
How much of that massive pool of dry powder, that $585 billion we discussed, will ultimately shift its focus to DFW's tight, high-performing neighborhood retail sector?
and what might that do to valuations in 2027?
It's a compelling future scenario that hinges on policy and market fundamentals converging. Thank you for joining us for this crucial deep dive into the state of commercial real estate.
We'll catch you next time.